Hey there, my name is Rachel from MarketEdge.com, your source for unbiased technical analysis on over 5,000 stocks and ETFs. With me today is Mr. Tom Ventresca, or as I like to call him, Mr. V. So today we're going to talk about the CTI, which is the Cyclical Trend Index, Timing Index. What does CTI stand for?
Cyclical Trend Index.
All right, and tell me, what is this?
Okay, Rachel. Cyclical Trend Index. We call it the CTI, and it is the cornerstone of the market edge market timing models. Now, when you say market timing models, when you're talking about the stock market, the first thing that comes into your mind is everybody tells you can't time the market. Well, I'm here to tell you you can. We've been doing it for 40-something years. We don't get every wiggle, but we get the big moves. And we're accurate around 75, 80% of the time over 40 years. And today we're going to show you how to do it. So the market timing models are what generate what we call our market posture. And our market posture is updated every week, Friday after the close. And it's either bullish, bearish, but sometimes when we're all confused, it'll be neutral. Now, the main item in the timing models that generate these bullish and bearish signals is called our cyclical trend index. Now, two things happen when you pull up Market Edge homepage. So the first thing you'll see over on the right-hand side of the screen on the homepage is you'll see the market posture, and it says bearish. And it's been bearish since October 24th, which is about 2-3 weeks ago. At that time, the Dow on that Friday closed around 47,200. Today, it's getting hit again. It's down to around 46,000. So far, this bearish call has been to the good side of 1,200 points. Now, next to the market posture box is the cyclical trend index, and that's what we're going to talk about today. And the CTI as of last Friday, again, these are updated at the close every Friday, is -9. Now, that number can range from anywhere from -12, 15 up to +15, 18. Whenever it's positive, in most cases, the market posture will be bullish. Whenever it's negative, in most cases, the market posture will be bearish. And sometimes, like I said, when we get out of whack, you'll get a neutral CTI and you might get a neutral market posture. So the first thing I want to go to is on the home page, you scroll down and you go to our market letter. Now, the market letter comes out weekly and it gives you the status of our various market timing models. And they're all summed up at the bottom of the page. You can see that there's mainly three. One's the cyclical trend index, which we're talking about today. It's -9. The week before it was 6. And the connotation, like I said, is negative. The other two that are prominent are momentum index, which is also negative, -8, and our sentiment index, -3, which is also negative. So when you have three timing models in your overall market timing model, and all three are negative, guess what? You're going to get a bearish market call. Now, to explain how this CTI works, we're going to jump over to the Market Edge Way, which is a free book that you can download. Now, just about everything in the book that explains the various components of Market Edge. And we're going to arrow down to the section on the CTI. And here we are, market timing models. First off is the cyclical trend index. That's what we're talking about today. This dates back to the 1970s. And the way this all got started was I read a book in 1973 by a fellow named Jim Hurst. And the title of the book was Profit Magic of Stock Transaction Timing. And in this book, he demonstrated that the stock market works much like all the various other cycles in the universe, especially sideways, in that there are 4 or 5 cycles, predominant cycles in the market. And the periods are the longest being like 4.5 years, which would coincide with the 4.5 year business cycle, down to as short as 5 or 6 weeks. And he showed in a very complicated manuscript, this guy was an aeronautical engineer out in Palo Alto, California in the 70s. This is before anybody knew where Palo Alto was. But he demonstrated that these cycles are prevalent. They've been there for a long time. And that if you can interpret them, you can come up with a pretty good timing model for the stock market. So in 1978, after battling this book for 3 or 4 years, I developed what I call the CTI, the Cyclical Trend Index. And how this differed from first work was we took the 5 cycles, here they are, and these are the average durations, and we assigned numerical values to each one of them every week, depending on how far along that particular cycle was in its cycle. So for example, cycle A has an average time frame of, let's say, 6 weeks. Picture this as strongmen. Each one of these cycles is a strongman, and the Dow, the stock market, is a piece of elastic. So week one, that particular strongman is exerting pressure, upward pressure, with quite a bit of force. As it goes along, that upward pressure diminishes. So come week 3, it's down to 0. And now down week 4, you start to get negative pressure. Week 5, you get more negative pressure. Week 6, a lot of negative pressure. So when you combine all of these by putting the numerical values on each one of them, depending where they are in the cycle, you come up with a number. And a number ranges anywhere from minus 15, 16 to plus 17 or plus 18. As I said before, positive numbers denote bullish market projections, and negative numbers are bearish market projections. That's how it works. Now, let's show this in action. And again, if you're a Market Edge subscriber, you can hop on the website and go pull up exactly what I'm looking at. But this is a chart of the Dow, and that's what we measure our calls against. And what you can see is at the bottom, I have the various cycles identified and their time durations with the arrows. Now, what you can see is that these cycles are called harmonic, meaning cycle B has an average time frame of 6 weeks. Well, cycle C will have an average time frame of, let's say, 12 weeks. And cycle D will have an average time frame 3 or 4 times longer. So you can see that in cycle D, which is quite a long period of time here, there's 2 cycle Cs, and inside cycle C, there's 4 cycle Bs. Okay, that's what's called harmonic. So you can see that when they all bottom, like they did right here in May on this chart, you got the B, C, and D bottoming. Well, the next week, they're getting positive numbers. So the CTI was actually going to jump up from wherever it was negative, and you can see the Dow was falling all along. When they get the positive numbers, CTI goes positive, and guess what? Here we go. That's how it works.
Okay, great. So, how should our users apply this theory?
If we go back to the Market Edge homepage, we have several publications that contain the market timing models. The weekly, which we looked at before, there's the Cyclical Trend Index, and it's saying it's -9, down 3 notches from the previous week. It tells you what status the various cycles are. B's bullish, A, B, and C are bearish. And then a neat thing we can do, we can also project in the future how long this bearish or bullish configuration will remain. And in this particular case, it's a negative, and it's projected to remain into December. This was as of last Friday, which was November 14th. Okay. And again, we come down underneath and on the letter, and you'll see the status of the Cyclical Trend Index for this week, the prior week, and the connotation, along with the other 2 models that we use, Momentum Index and our Sentiment Index. Now, in addition to that, we have a publication that comes out once a month, and it is called On the Edge. And there it is. It comes out every month. And in On the Edge, you're going to find something that's pretty clever. Scroll down to CTI. This came out at the end of October. And you can see that at that time, and it still is, the CTI was negative. This tells you the status of the various cycles. Remember I said there was 5 cycles? We've got A, B, C, D, and E. This tells you their duration. We looked at that before. And this is the number of weeks since each one of these cycles bottomed out. So this is how far along is the cycle. So cycle A is expected to run about 6 weeks. It's 2 weeks long. B, 18 weeks. It's 13 weeks long. And C is 36. It's 29 weeks long. So you can see that all 3 of these front cycles have about 4 or 5 weeks remaining until we expect some kind of a bottom. And that's why we can project out and say that this call that we currently have on is probably going to last deep into December, 4 or 5 weeks from now. I'll put it in the middle of December. And then we have the connotation. Okay. Cyclical is still bullish, bearish, bearish. That means that counts that turn negative since their previous bottom. He's still bullish and bearish, and he's bearish. So underneath that, we assume that you can't figure that out. So that's okay. We have the projections, what the CTI will actually be for each week going forward. And this runs through the end of November. And you can see it's -6, -6, -9, -9, -9. So if you go take a look at this particular publication, which again, this is on the edge, it's on the homepage and it comes out every month. You not only see what the market posture, which is, look at it here, the bottom, market posture negative. This is a track record of how it's been performing for the last few years, how the market posture is the CTI plus our sentiment, our momentum index. So it gets a little different reads than just straight CTI. You can see how the market posture has been performing for the last 2-3 years.
Oh, that's interesting. Can you tell us a little bit more about this particular chart?
Okay, this is performance for the last 3 years.
Hmm.
So when our market posture is bullish, that's a strong period, right?
Hmm.
Favorable period. And when our market posture is bearish, that's a weak period. Okay, so we go back to the beginning of this. This starts March of 22.
Hmm.
That's 3 years ago. Over that period of time, if you had been a subscriber to Market Edge and reading on the edge, the market posture would have been bearish. During those dates, that's where it started, 34,754. That was the close on the Dow on March 18th. 32,977 was the close on April 29th. The market went down 1,700 points. Okay.
Okay.
Horrible call.
Yeah.
The next one is the same deal. Then we have a couple big winners, a little loser, big. When you mush all this together, what you find out is this is right around 75, 80% of the time over a long period of time. We're talking back in the 70s is when I started doing this, which was 1978, I believe. So 80. So what's that, 45 years?
Yeah.
A lot of history. Okay. And then this is when market posture is bearish. Right? And the exact same thing. And you can see how it ruled. Look at February 28th, 25 of this year. Got negative when the Dow was almost 44,000 and stayed that way until the Dow was 39,000, 4 or 5,000 points on the Dow. So although it's impossible to call every wiggle in the market, and I agree, it isn't impossible to determine when the market's favorable or unfavorable. And when it's favorable, you obviously want to be involved. When it's unfavorable, you don't want to use some type of stops or whatever. If you're real aggressive, you can short stocks or even buy put options. But the idea is at least have a feel whether the market's going up or down without having to watch the guys on TV every day. Okay.
All right. I think that's it for Cyclical Trend Index, the CTI from MarketEdge.com. If you have questions for Mr. V or anyone on the Market Edge team, feel free to send us an email to support@marketedge.com or drop a comment if you're watching on YouTube. Thanks so much, and we'll see you soon.